Very welcome, everyone. My name is Nicholas Tan from Kenanga Futures, Sudan Berhad. Thank you for spending your precious time to join our webinar today. It's a joint collaboration with CME Group in our effort to create awareness and provide education on listed derivatives to the participants. We have returned with our nationwide campaign, Accelerate into the Futures, and stand a chance to win prizes worth up to 50,000 ringgit when you trade Malaysian and also US futures contract from 2nd August until 29th of October this year. Besides that, Kenanga Futures has also launched 5 new CME Group's micro and mini products, which are the mini soybean, mini corn, mini wheat, micro silver, and also the micro WTI crude oil. You can now trade smaller size CME futures contract like the mini soybean and also mini corn with less than 4,000 ringgit. So to learn more, please visit Kenanga Futures website, www.kenangafutures.com.my. Please take note that futures and options trading involves substantial risk due to leverage factor and may not be suitable for all investors. This webinar is purely for educational purposes. Kenanga Futures Sudan Berhad accepts no liability whatsoever for any direct or consequential loss arising from any use of the content of this webinar. Right, so before we start, we would like to take this opportunity to invite you to Kenanga Futures' next webinar, which is on 26th of October. It's about technical analysis and market outlook on precious metal. Don't miss out, save your date now and get yourself registered. Also, if you have any questions along the session, please feel free to drop your question at the Q&A box. It's on your right side. It's the same as the chat box, right? So today we have Mr. Brandon here, and he's going to share with us about things to look out in 4th quarter for CME corn and also soybean. So without further delay, I would like to kickstart our webinar by welcoming our speaker today, Brandon. Brandon, over to you.
Okay, I'll click on the share screen. Okay.
No, I can see your the presenter slide.
Okay. Let me terbalik already one. Hold on. If I change my screens to sorry, let me stop staring for a while. Give me a minute, I'm sorry about that.
Yeah. All right, while Brandon is handling his slides, please pre-register yourself for virtual trading by Kenanga Futures. I have sent the link in the chat box. At the same time, I have also posted up the link in your webinar gem, where you can just click sign up and it will lead you to the virtual trading game platform. Please pre-register yourself, and we'll be playing this virtual trading game later on after Brandon's session. And we are giving out some fantastic prizes, yeah? All right, so, okay, Brandon, your side ready?
Yeah. Okay, this. How about now?
Yeah, good.
Okay.
First screen.
Okay, thanks, Nicholas. Nicholas, so I guess you can hear me loud and clear now, just now.
Yeah.
Okay. Yes. First and foremost, I would like to thank Kenanga Futures and CME Group for making this webinar happen. Good evening, everyone, and hope everyone is doing great. Thank you for attending and spending the time with us today. So I'll be talking about things to look out for in Q4 in CME corn and soybean. Okay, before I start, I would like to say that whatever I share today is for education purpose and my personal view on the market. It does not represent any investment or trading advice, i.e. buy call or sell call signal. It is my personal experience, especially future contracts are highly leveraged instruments. So it's best to consult your future broker to understand better, especially if you are new to futures contract. So what I'll be doing today, all right? I'll be sharing my trading experience, okay, a bit of my background. I used to work in Singapore where I co-manage a commodities futures portfolio. That's where I learned about proper risk management and proper size trade, all right? And then currently I'm working in the prop desk in a palm oil mill, all right? Currently I manage my company proprietary and hedging desk. I do trade crude palm oil, microdal, soybean, corn, meal, you name it, anything in CME, I also would have traded it. All right, as long as justify the risk and reward strategies in the end to make money. All right. I'll be spending around 40 to 45 minutes to go through the slide. I'll be sharing what method that I use. So today will be like a crash course for most of us here. I hope you all will ask me a lot of questions. That's where you're going to learn. Okay. I'll be sharing the fundamental pattern and technical analysis for the last quarter 2, 2021. To understand how to trade better in the last quarter of area, we need to know the planting seasons to understand when is the producer is planting and harvesting. In any commodities we trade, we need to know the seasonality of the market itself. For the seasonality, we can understand the probability. In example, the math behind the story. From there, we can look into the demand and supply to understand why the seasonality happened. Next, we will look into the market structure. Market structure will explain the bigger picture of the market. Market structure is like looking at price forward curve. Is the market in backwardation or CONTANGO? I'll be talking a lot this today. A lot of most traders, they don't pay attention to the market structures. All right. I think it's because they don't understand, but I think this is where people should pay more attention to. Lastly, I'll be sharing my quarter 4 outlook and what I'll be doing for this quarter. Some of the CME products that offer are corn, wheat, meal, soybean oil, live cattle. And now that, like Nicholas has said, they have new contract, mini corn and mini soybean. I personally do like these two contracts quite a lot because I do a positions mini corn now actually. And all these products are offered by Kenanga Futures. Yeah, let's jump into CME soybean futures contract spec. All right. This is a bit boring, but we need to go through it to understand a bit more, and for newbie to understand what they're trading. Things that we need to know is, okay, for soybean now, one lot margin is equal to 5,000, so it's equal to $5,000, so it's equivalent to 20,000 ringgit, and one future contract value is equal to $50. One tick movement is 0.25, and one tick is equivalent to $12.5. And for most of the Muslim friends, soybean and corn is same as palm oil. You have physical delivery, which means I think in terms it's called CHIA compliance. The trading hours is this Malaysia time from 8 a.m. to 8:45 p.m. Then with a break 9:30 p.m. to 2 o'clock in the morning. For mini contract, it's smaller. All right. The one margin is around $891, so it's around 4,000 ringgit. Contract value is smaller. It's $10. Previously is 50. Take movement is moved by 0.125. The big contract is moved by 0.25, but one day movement is much smaller. It's $1.2. So how do we calculate? To understand how do we calculate the profit, you need to know about one future contract. All right. So example, you bought one lot soybean January 2021 at 950. You sold. The price dropped to 949.75. The one tick movement is 0.25. So basically you gain $12.5. The full contract size, we call it notional value, is example here, $950 times with 50. So the full contract size is actually 47,500. This is where I want to be a bit more specific. So you're using 5,000 margin to trade one lot of soybean. Do you know that actually if you use this and based on $950, you're actually leveraging 9.5 times. This is very high personally. All right. I personally leverage for my portfolio, I leverage around 3 to 4 times. I never leverage more up to 4 times. Very rare. Maybe if most of the 8 times there's day trade only. But if owner positions, I will leverage up to 3 times only. So by buying one lot of soybean, you have used $5,000, but you're actually leveraging 9.5 times. For the mini contract soybean, the full contract value is $10, so the margin is 891. All right, but the contract movement is 0.125, so it's equivalent to 1.25. And based on this margin, 891, you're also actually leveraging around 10.6 times. But the good thing is, because the margin is smaller, so you can put 2 lots or 3 lots, so your leveraging is small, less than that, or you put more margin. So basically, when you trade 1 lot of soybean, it's equivalent to 5 lot of mini. When you have 5 lots of mini soybean, it's equivalent to 1 lot of soybean. This is an example of typical trading hours for soybean contract, like I said just now, from 8 o'clock all the way to 2 o'clock in the morning. This time, sorry. Okay. Even though it trades 18 hours for the day, but most of the new one and the old one, the traders, they must know when the active hour. I personally would like to divide in soybean and corn to divide into 3 sessions. One is Asia time, one is Europe time, and one is US time. In Asia time, most of the time I would say it's range bound. All right, it will just go sideways and this out. And then when it comes to 4 o'clock, that's where the Europe markets opens. That's where it tend to start to get active and start to tend to have a trend. And then when it comes to the 9:30, when the US markets open, that's where the real volume comes in. You can see that this is the volume. So when normally around 8 o'clock, normally there was sort of a trend. All right, then at night, this is where the real volume comes in. This is for soybean. Now we'll move on to the corn. Corn, to trade 1 lot of corn, you need $2,100 US. The movement is 0.25, same as soybean, 1 tick. 1 tick is equivalent to $12.5 US, and it also has a physical delivery. And the trading hours is the same also. For mini corn, the 1 lot margin is $3,079 US. 1 contract value is equal to $10 US. And 1 tick movement is 0.125, and they also have physical delivery. So I will emphasize again. The full contract value size you need to know is, so let's say the price now is $530 US. I think for 50 bushels, you need times 50. So the full contract value when you buy 1 lot of corn or sell 1 lot of corn is 25,500. Oh, sorry, there's a bit of a mistake here. You divide by the margin you have, 1 lot margin, you're actually leveraging 12.62 times, which is, like I said, it's very high. Futures are leverage product, so you need to know how much you leverage. For most of risk management, most people think about stop loss. But I personally would like to know how much am I leveraging. This is very important. So for the mini corn, I'm sorry for my mistake here again. 10 US, here's supposed to be $10 US, and the margin, so sorry about that. The margin is supposed to be 379. So you're actually leveraging 13.98 times, which is still very high. That's why you need to trade at least 5 lots to have 1 loss. Same as soybean, the trading hours, I personally would like to divide into 3 hours: Asia time, Europe time, and US time. The biggest volume is normally the US time. So what's soybean for? For more of us, soybeans is, in Malaysia, we always think it's just for soya meal and tofu. But in fact, soybean is one of the most important food staples and can be used for a lot of things. This is all because of the rich in protein. When the producer buys soybean, when they crush it, they actually want the meal, 80%. 80% when they crush it is the meal, and this is used for animal feed. Only 20% when crushed is soya oil, and this is for cooking oil, biodiesel, industrial use. So the main thing for soybean is actually animal feed and the food product. For corn, it's also a similar thing, all right? And corn is the biggest crop grown in the world. Corn is the most popular food that we consider as a vegetable or whole grains. We can eat as sweet corns or popcorn. We can make it with syrup. However, corn is primarily to feed. It's for livestock. Only roughly 5% is only used for food that we eat for humans. As you can see from this chart, the blue line is for animal feed. The green line is for ethanol. The pink line is for human consumption. So actually, when we plant corn and soybean, more time it's actually for industrial use, for animal feed use. So some interesting fact, when you trade CME corn and soybean, you need to know where is it planted. Soybean and corn mostly plant at the Midwest, but this is what we area called Midwest. So you need to know the weather there. All right, give you an example. 2019 and 28th of May. Normally this period of time is we call it planting period, all right? But there's a very huge extreme weather in the Midwest. Right? So when I trade this corn and beans, I like to hear this kind of things, weather problem in Midwest one. So we have this problem. We have problem in Midwest weather, which means there are uncertainty. When there are uncertainty, farmers normally are in deep problem. So this is what we call trade the news. So what happened is during the time on the 28th, the market suddenly gap up the next day and just trade higher and higher and higher. So this is the planting seasons. This is the thing for newbie and most of people they need to get familiar with. For both and North America, planting and harvest times are totally different. For example, northern hemisphere country like US, China, they start planting from here April to June, and then they start to harvest from September to November. But for the southern hemisphere country like Brazil and Argentina, they normally harvest from February to June, and then now they start planting from August to November. So this is planting seasons you need to know. So once you know this, you will know that once the funds going to hedge their crops and when they're going to reverse their positions. By saying this one, you need to know what is the crops possession and conditions. One advantage in trading in US market is transparency, especially when you trade CME product. They will publish all kinds of information for us to use. Even if you're a retailer, you can even get this information. So you just need to go to USDA. You just need to go Google and type USDA, crop progression and condition. You're able to find this. These are things I do follow and keep track of. For example, in this case, this is crop progression and condition for soybean. This line is this year conditions. The smallest one, this one is for this last year. Well, this is the average 5 years, 4 years conditions. So when we trade Q4, normally we need to pay attention to this period. We need to know currently the harvesting, all right? So we need to know how's the harvesting. This year, this is a bit delayed. This is a bit lagging. The latest one, the harvesting for soybean have been above last year and above the 4 years, which means this year the crops has been good. All right, you can see that, in fact, booming as when they're setting pots, even dropping Philip is much higher compared to the last few years. And harvesting should be superior, which means this year the harvest is good, which means they're going to have more supplies on this also. Same thing for corn. All right, you can get this information from the USDA report, but the slightly difference corn and beans you can see is beans plant during the mid-April, while corn plant beginning of the April. All right, and during September they harvest earlier compared to soybean. This is just the rough information that you guys can keep track of. I do keep track now, I guess, because when I see this, I know the crop is much higher, so I think the supply will be much higher than expected because the condition also is in between last year and this year. All right? If the condition is way below here, I would say this year we're going to have quite a bullish year. But if around here, I would say it's pretty much normal. Okay, this is where it gets more interesting. This is the soybean seasonal. Before looking into seasonality cycle, the effect on commodities trading, it's important to note that seasonal cycles are very helpful indicator for all traders. And you should add this into your playbook. I do follow this quite often. Why seasonal happens? Because of demand and supply during the whole year, course of the year. For agriculture's market, supply depends on the harvest, planting, weather conditions, and transport. Demand is influenced by cyclical consumptions, export pattern, and feed demand, animal feed demand, while supply is influenced by planting acreage, yield, and conditions. Just now we are mentioning this is more to the supply side. This is where you can able to explain more on the demand side. This is what we call a heat map. This heat map, you can see that it can show us every year from 2010 until 2020. So you have 10 years of average up and down. While here you can see the average from 2010 to 2020 up and down. From here you can see that normally during June, I would say July, August, Sep period, soybeans tend to trade lower. And when towards the Q4, now soybean tends to trade higher. So this is the right rough gauge for you. After that, I will explain how can we explore this. This is corn seasonality. This is also the heat map. Corn have quite a similar pattern to soybean because of both of them are planting and housing the same period. Normally, I would say during July, August period is when the weakest time. But after that, during December until the next year, February, this is where the corn tend to be the strongest period of time. So that is a guide for you to understand what is going on to the commodities, because it do happens most of the time. You see here, for Q4, most of the time you have more green. For December time, you have more green than your red. This is market structures. Here is going to be a bit more in depth, even for some of the advanced one, because most of the people they don't talk about these factors. They only talk about technical analysis. When I look at certain commodities, especially when corn and beans, I always look at, is this market in contango or backwardations? Because the forward curves will tell you a lot of stories. So examples here is a forward curve. So for February, you can see that from February, because when you trade soybean and corn, right, you'll see the contract, you'll see February, May, August, November, December. Then you'll see next year, you have this curve. And any commodities you trade in futures, you have this kind of curve. This curve will tell you the fundamental more, right? Because most of our fundamental information, including myself, we tend to be a bit slower compared to the real physical guys. So I will use this as a guide to give me a better picture in this market. So when a market in this condition of contango market, which means the spot price, the nearest spot price is lower compared to the future price. That's why you have this curve like that. Normally when a market is in contango, this means the market is slightly bearish. It's really on the downside because people are not rushed to buy. That's why people will wait for the price to come down and then they will buy. Well, this is backwardation. Backwardation is totally opposite compared to contango. The spot prices tend to be much higher compared to all the prices in the future price, which means in fundamentals, most predicted for stock tightness, and there's more demand and less supply. This is the reason why the market were in backwardations. From this, this will give you a bigger picture, then you will decide what you want to do with the market. Yeah, let's take a example. Last example, all right, to illustrate example. This is the for how to put a soybean. This is a soybean forward curve and how it's changed over times. The yellow is the August during period. All right, you'll see the September, November, January, March. This is the prices for the soybean. During August period time, you see the price is quite flat, which means it's not $194 US, which means most of the price is the same from September until July. But when we move to September, you see the curves start to bend and change. All right, they will start to change to a bit like backwardation like that. Then October is even steeper. Then it comes to November, you have a huge backwardation here. So what does this tell you in the stories? Okay, this is the picture. Maybe I put into the figures to have numbers for you to have a look. During the October 29, January price is 956, but the May price is 957. If you minus this, you can see the January price is lower compared to May price, which means the market is in contango. But when it comes to September, you see the January price is 1,000, while May price is 996, which means the market is from this contango when it moves to backwardations. Contango move to backwardation. You see this. When it comes to October's, for January and May, you can see the spread is even bigger, from 154 to May 136. So how does the market structure change reflect the real changes in the soybean price? So you can see that on the 29th of August, 28th of September, and 28th of October, you'll see that once the spreads, from here, CONTANGO, change to backwardations, you'll see the price tend most of the time, theoretically, most of the time, we tend to be more supportive and more bullish sign. And in terms of technical, you can see that it started to trade above the 150 moving average. This line is 150 moving average, and this 50, and this 10 moving average. So by using this, I will be able to gauge the last quarter for this year, how am I supposed to trade this market soybean. This is for corn curve, the forward curve. The other line is during the August time last year. You can see the curve is in CONTANGO. September, the curve started flat, and October really flattened. And then on November and December, it started to have this more backwardation curve. This illustrates how is over time the curve change when the pattern change. When the pattern change, the price also change. So let's take close to the numbers and see. On the 8th of on the 9th of August, you can see the December price is much lower compared to the September price next year, 2020 and 21. Then when you move to October period time, you will see the price is December, March, especially March price, it will start to go higher to September price. This is what it shows. When I say this, it shows that the market is moving to a bullish side. It's tend to be more supportive side. And then, as you know, that seasonality-wise, quarter four is always the highest. Maybe this explain why. So in the chart-wise last year, what happened is August period, especially September time, when the price, this one, start to go flatten, and it's starting to go flatten, go higher, you'll see the price trade above the 150 moving average, and the price start to trade upwards all the way. So by seeing the curve changes, by seeing the market angle of backwardation, you roughly know that if the market is in a what kind of trend. Is it in an upward trend or downward trend? If not, after this, you can go have a look. Most of the commodities now you have is all in backwardation. All is in the bullish period now. Okay. Just to recap what I've said, because I went through quite fast, so I hope you can ask more questions later. So when we trade corn and soybean for new one, we need to know what's the planting season. On March, okay, normally on March, the farmer will decide what to plant. In US, during March time, the farmer will decide to plant corn or soybean more. After that, they will start planting during April to June. That's where we will see this is where we will see the planting and the emerging for corn. It's the same thing. And then you will start harvesting from September to November. Hence, we need to keep track with the USDA crop and condition reports, as I showed just now. Due to the planting seasons, you will know that seasonality pattern as a seasonal pattern for both from April to June, July, and August is a planting period. Normally, this is where the farmers will hedge their positions. All right, this is where you get to hedge your position. When it comes to harvest period, normally they will unwind positions. Why I say that is, because during the planting season, April to June, the farmers, the producer will know that how much they have in hand, how much they have planted. So when they know how much they have planted, so normally they will use the CME futures as a risk management tool to sell the contract to hedge your position. This is reason why you will see that normally the price is peaked at mid-quarter one. So when it comes towards the housing period during the September-November period time, normally that's where they really know that how much they have how much they're going to harvest, and then they'll start to unwind the positions. This is why most of the time the markets tend to be bottom at Q3. And as they start selling their crops, the produce, there'll be less supply. Then the reason why normally in Q4 you will see the price tend to go up after Q3. The point is we need to know the market structures, the forward curve. We need to know is the market in backwardation or contango. Contango means the forward price is more expensive than the spot price, for backwardation, which means the forward price is cheaper compared to the spot price. With this, you're able to gauge what is the market trend now. So how do we treat CME Corn and Soybean using technical analysis? Technical analysis, personally, I think it's a very broad subject. All right, there are many school of thoughts out there, but the common technical analysis, the common tools you can use is candlestick, moving average, MACD, stochastic. Then you need to know that what time frame you want to use. You want to use daily, hourly, or 10 minutes. After knowing what kind of time frame you want to use, you need to know what strategy you want to use. Do you want to use a retracement or breakout trade? Aaron have different preference on this. Some markets, it's better to use retracement trade, while some markets is with high volatility, it's better to use breakout trade. But do keep in mind that there's no technical indicators that are perfect. Like when I first trading out, I always look for the Horigyo. For me, personally, I've been trading for a decade now. I would say that normally in technical analysis, the indicators are lagging. Normally, I would say it's lagging one. All right. Most important goal when you use technical analysis is you need to anticipate what's going to happen, and then you need to participate the market move. The participate is where the technical analysis part. Anticipate is where the fundamental part. Okay, let me illustrate one of the methods that I use. This year, all right, this is a real scenario during the May this year. If you look at this is soybean chart, all right. By purely looking at this soybean chart, for most of the beginners or for most of the time, you think the market is on the bullish side because we are trading above. This is my 150 moving average. This is my 50 moving average, and this is my 10 moving average. I have to agree that this market looks very bullish during the May time. However, commodities are different animal due to the planting and supply demand side. All right. Seasonally, as I mentioned just now, we know that soybeans tend to peak at May and June. Let me go back. I'll show you. Soybean, all right. They tend to peak around this period. On average of 10 years, you tend to peak around this where it start to come off. You go up a bit, then you go off again. So what happened is during May this year, when it comes to May this period, so I will anticipate that even the market keep going higher, this might be the high already. Because seasonality, May is always a peak. So what I normally do is I will anticipate this is a peak. Normally at this period, I will not try to buy, even if you retrace. I will try to look for sell signal. So how do I determine where to sell? First of all, price is moving away from the 50 moving average quite far apart. When it moves quite far apart, and then you start to have this kind of long tail, and then shooting stars. This is start to form a bit of bearish signals for me already. So especially when it break new high, and it come off, break new high, it come off, then with the shooting stars, and it's moving far away from 50 moving average. And then with fundamentals, so this is where I will start to sell. This daily, what happened is I will zoom in into 30 minutes chart. This, this is shooting stars are basically, these shooting stars. So coincide with break new high, it come off. All right, then when it goes below my 50 moving average, my long-term 150 moving average, it came off, come up, and that's where I start to sell. I personally prefer when the market trade below the 150 moving average, and that's where I tend to look for a sell signal. I will sell. All right. So, like example, this scenario, the market is peaked at May. So when the price actual movement trade below the 150 moving average, I will normally look for sell signal, and I will draw a trend line like that. Normally, this kind of chart here, I would not trade, even though market is going up, but I will not buy because I know that May, most of the time, market should be peaked. All right, this is the period of time I prefer to sell, will not look for a buy. So once you go below 150 moving average, coincide with fundamental and technical. This is where I look to sell. Then I will draw a channel line. And then once it break the higher low, the higher low, then I will get out. So just to recap, I use seasonality to anticipate what's going to happen, then use technical just to participate the trades. So this year, in Q4, how do I look at the corn and soybean? First and foremost, we need to look at the bigger picture. This is a soybean future forward curve. On the 1st of August, the curve is to look like this. And then on the September, in fact, the curve is from backwardations to CONTANGO. And on the 10th, it's even steeper, all right? So like I said, when the market is CONTANGO, which means the market normally tends to be in the bearish side. And then in terms of technicals wise, the daily charts do affirm that, on the last Friday, this is the last Friday chart, the daily break the 150 moving average, coincide with increase in open interest. This is the increase in open interest. Normally, when the market break 150 moving average with this increase in open interest and this CONTANGO market, I personally think the market is quite bearish on the downside. But having said that, we're in the Q4 now, so this kind of trade I will try to avoid it. But how do I going to trade this soybean? So this is the 30-minute charts. All right. Just nice when you see this chart, the markets, what they do is they have a channel line like that, and the high is getting lower and lower and lower. So when the high is getting lower, you can draw a channel line like this. All right. If then the next question is I want to ask myself is, will I buy or sell this market? Personally, I would sell this market because of the market is CONTANGO now, but I would on the 10th of October this month, when the USA report is on the stock, then how I see go from here. But if I have a choice, I think soybean this last quarter is a bit tricky, all right, because we are moving into Q4. Q4 in terms of seasonality, price tends to goes up, but our market is still in CONTANGO, so it's a bit of mixed feeling. So I would say we will trade around this channel line, unless there's a huge change in this CONTANGO and change to backwardation, and then that is where I will start to look for a long signal. If not at this moment, I personally think the market should be trading around this channel line and start coming down low to start creating, unless you break this channel line, and then it start to trade back above the 150 moving average. For corn, this is a September curve, and this is the August curve, and this is the September curve, and this is the October curve. Well, this market is also in the CONTANGO period, which means it still be a bearish side, but the difference is on the October, you can see the curve start to improve better. It's not as steep as before already. And for the daily chart, you can see that the corn price, it touched 150 moving average and it bounced up and coincide with higher open interest. Both for the corn and chart, both in the corn and beans, right? You can see both of the open interest start to change already. Which means there's small changes. But in this corn, I personally prefer to long it because it's still above 150 moving average and the open interest start to increase already. And both of them are quite different now. So if this curve start to flat and the open interest start to maintain, and start to maintain 150 moving average, and with seasonality in Q4, market tends to go up. In this market, I prefer it to long it and start to have a lot of shooting star and long tail here. In terms of 30 minutes, you also break the lower high and start to create the higher low now, which means the markets are a bit supportive already and start to track moving average. So if you ask me, corn, what do I think? Corn now, I think we're moving to the Q4, and I think I still prefer the low to buy. So this is my view on the corn and beans chart. So let's move on to questions. Okay.
All right. We have questions here from Wendy asking what's the reason that the biggest volume is from the US market?
What's the biggest volume? What's the biggest reason volume from? Okay. Let me go back to the volume chart. Okay, first and foremost, CME created this soybean and corn contract, all right, and that's why most corn and beans are mainly produced in US market, in US, they're planted in US. Only lately, for the past 5 years, I would say that Southern America start to overtake US as the biggest producer. However, that US is the biggest producer for corn and soybean. Most of the corn and soybean, we're getting is actually from US, I would say. But now I would say we're getting from Brazil and Argentina. So because of that, corn and soybean is the first contract that created in, I think, in CME, and then it's become the benchmark. Basically, it's a benchmark already. So it's like benchmark. It's just like CPO, in CPO in Malaysia. Although we're not the biggest producer, Indonesia is the biggest producer. Because we're the pioneer, we created the soybean contract. Created the CPO contract first. So now we become a pioneer, and then it's become a benchmark, and everyone just followed that. Even though Thailand already have a RBD all-in, or Singapore already have a farmer contract, but everyone is still using our BMD CPO as a benchmark because we're the pioneer. So I would say that same thing as CME. CME is a pioneer that created corn and soybean contract, future contract, and this is the reason why we become the benchmark, and then it's where all the volume goes into. Okay. Okay.
Right. So far, that's the only question we have. Do you have any more questions? Please post it in the Q&A box. Right. Let's see. Okay, looks like we will move on to the next session first. I think we can play the game first. If you have any questions for Brandon, you can actually post it in the chat box and we will come back to it later. Right? So let me try to move on to the game session. Okay, let me try to share the screen over here.
Oh, I think we have questions.
Let me see. Okay, current oil price is rising high. Will soy oil follow to raise?
That's a very good question. With the crude oil price going up now, all right, that will affect natural gas and the rest. So naturally, back in the days, all right, because there's a spread we call bean oil and gas oil spreads, all right. So when the price of crude oil goes up, then gas oil price will goes up. When gas oil price goes up, then there's a spread between bean oil and gas oil. So if the spread is too wide, and then the producer will have initiative to produce bean oil as a substitute for biodiesel. So back in the days, the benchmark is, I think, once crude oil hit, I think 85 to 100 US dollars per barrel, and then that's where the bean oil will start to have more incentive to produce. So logically, theoretically, yes. And one of the things that people do not know, so when you trade CME soybean oil, all right, let me go. When you trade CME soybean oil, US do not export soybean oil to other country one. only Argentina export soybean oil to other countries. So in US, what they do with the soybean oil is for industrial use and biodiesel. And if you do follow the biodiesel news quite closely, you'll see that Biden has been quite a pro person on the biodiesel. But for the past 2 months, suddenly he put his handbrake, and then that's why the oil price has been coming down. If Biden comes in there, you give a mandate that we need a biodiesel, soybean price will skyrocket also. So with the current oil price going up, to answer questions, I would say soy oil price will follow also. And because today I didn't put into the chart, all right, the curve. If you look at soybean oil curve now, it's actually in backwardation already, all right, which means the market is quite bullish already. So I would say, yep, if oil goes up, so oil goes up also, and so oil looks quite supportive at the moment. Personally, for me, I personally think the so oil is quite supportive now, same as palm oil. Yeah.
Okay. All right. So, okay, we'll then take this question for now. Okay.
What are you clicking?
Click KenangaFutures.com.my, Malaysia's leading derivatives broker.